Okay, in the last video, we had a look at the transaction accounting by buyer, who is, in our case, Sean. Now, let's pay attention to Chan's record keeping. Then, again, Sean was a buyer. And now, let's have a look at seller's viewpoint. Then, from sellers, well, obviously, he says something, meaning Chen records the sales. And sales or revenue, I discussed that I will use them interchangeably. So sales or revenue, its normal balance is, yes, credit side. So sales increases on the are credited of $110. $1,100. But did we receive cash? No. We need to record. Accounts receivable, $1,100. And in this case, let's assume that to have a look at seller's viewpoint, FOB destination. Okay, the same amount. Again, you cannot contain both of the terms FOB destination and FOB shipping point on the same contract, right? I'm just assuming that independently from the previous video. In this video, let's assume that FOB destination is printed on your contract, meaning it's seller's time to pay. It's a multi-universe, right? Another universe that seller pays the shipping. Okay, why in this case the seller pays the freight fee? Because to make a sales, right? So this is a type of expense, right? That should be matched to the sales, right? Revenue recognition principle, expense and matching principle, right? So this is a necessary expense to make the sales. So we will treat it as an expense. And expense, you see, its normal balance is, yes, debit side. So we debit freight expense, paying out cash. But that's not all. It's not the end of the records from seller's viewpoint. What other costs are there out there when you make sales? Chen is a seller, but also he or she is a manufacturer. He or she makes the iPhone cases. So we should consider the manufacturing cost. We should journalize the manufacturing cost. Meaning, manufacturing cost should be debited or credited. Cost or expense, they should be, yes, debited. And this kind of manufacturing costs are called cost of goods sold. Okay. Well, if you say cost of goods sold is the same as manufacturing cost, that's not correct. But before studying managerial accounting or cost accounting, you may say that the major component of cost of goods sold is manufacturing cost. Okay, to say specifically, usually just for the inventories, but forget about it. Manufacturing cost, cost of goods sold is mostly similar to manufacturing cost. Okay, and let's assume that from seller's viewpoint, manufacturing cost is about 30% of the price. Okay, then in this transaction, 30% of 1100 is 330. And he sells out something, meaning the goods that are ready to be sold out is being reduced, meaning inventory reduces by the same amount. That's Chan's journal entries on January 1st. And then on January 2nd, Chan receives the defective inventory. So he or she needs to increase inventory by 100. And what else? I think it would be better to write down the transaction about the journal entries about inventory here. Meaning we need to flip this record by $100 amount of the cost, meaning 100 times 30%, which is $30. Yes, we flipped this transaction, but also we need to flip this transaction. For simplicity's sake, let's assume that there's no freight cost here. Okay? We need to flip this transaction, meaning sales and accounts receivable 100 and 100. But that's not the end. This is sales being returned, right? Do you think this is important? Yes, it is. If after making, say, 1 billion amount of sales, if you see out of 1 billion, 0.9 billion, most of them are returned back, then you should suspect that, oh, something is wrong with this business, right? The quality is not controlled, or the marketing was too much aggressive, right? Something like that should be suspected. That is, sales and the amount that is returned back contains important pieces of information. Okay? So the accounting standards state that you should keep the record. So we do not directly reduce sales by debiting it, but we create a contra sales account called sales returns and allowances. All right. So instead of, again, reducing sales directly, we create a contra sales account called sales returns. All right. And then let's move on to January 8th. What happens is, say Chen receives cash. How much cash? We've already seen 980, right? And then we need to erase the accounts receivable. Which is we know that originally it was 100 and 1,100, and then 100 is returned back. So the balance is $1,000. The balance for accounts receivable is $1,000, meaning we need to have something in between as on the debit side. What is that? It's the discount offered, right? Sales discount, which reduces the sales, right? Then can we directly reduce the sales? Let's talk about, again, another case, which reported sales of $1 billion. Yay! And then there's a catch. The company says to you, to an investor, that, oh, out of $1 billion, it's too early to be surprised. We offered 0.9 out of $1.9 billion amount of discount. What? Then, yeah, something is off, right? So we should indicate that report sales discount different from sales gross. What I'm saying is, when you report an income statement, you report sales, which is gross. You have to subtract and then subtract out and sales discount. Then you have sales net. Okay, Levi. We have a look at annual report. And as we've talked, they are reporting net revenue, and usually at the end of the notes, you see valuation and qualifying accounts. Click it, and then you will see how much are returned back and how much sales discount and incentives are offered and the changes about them, right? For example, in this company's case of Levi, their latest annual revenue was their thousands, so $1.3 billion. After taking out all of the discounts and returns. And out of 1.3, you see that the returned amounts, the changes, right? Well, at the end, let's have a look at the ending balance. Is about 53, the same, right? Thousands. It does not say that clearly they are thousands, but about 53, close to half. Oh, this is 2018, okay. Well, sales discount offered is about 1%. Sales return, there are no change. Okay, charged and deductions are the same in the last year, during the last year, so that there are no, and the beginning balance was 0. Okay, so it appears that they cleared up all of the sales returns. Right, cool. So you are seeing that you are seeing the changes in the sales returns and the discounts in details. by analyzing it, you can see how much incentives the seller has offered to the buyers so that they can boost up their sales. Okay, we've studied journal entries by sellers and the buyers, and in the next video, we'll move on to a detailed discussion about multiple step income statements. Okay, see you there.